Hey everyone, welcome back to my channel. Don't forget to click subscribe if you want more weekly updates on investment strategies. The Turkish stock market faces growing threats as bearish signals accumulate. Turkish Central Bank is expected to raise its one-week repo rate to 30% from 25% when it meets on Thursday. I expect the BIST 100 index will pull back to 7350 as a first support level with interest rate hike by Central Bank of Turkey. The IST 100 index will even go down more to 71.0 level, which is in line with two-day moving average line if interest rate hike is more than expected. The relationship between interest rates and the stock market is complex, and there are several factors that can influence stock prices when interest rates rise. Here are some of the key reasons why stock markets may go down when interest rates are higher. Higher borrowing costs. When interest rates rise, it becomes more expensive for companies to borrow money for investments, expansion, or even day-to-day operations. This can lead to lower corporate profits as borrowing costs increase, which can negatively impact stock prices. This may cause the increase in banking stock prices. Opportunity cost. When interest rates are higher, the returns on fixed income investments such as bonds become more attractive compared to stocks. Investors may shift their money from stocks to bonds in search of safer and more stable returns. This can result in a decrease in demand for stocks, causing prices to fall. Discounted cash flows. Stock prices are often determined by discounting the future cash flows of a company to their present value. Higher interest rates lead to a higher discount rate, which can reduce the present value of those future cash flows, putting downward pressure on stock prices. Reduced consumer spending. Higher interest rates can lead to increased borrowing costs for consumers as well. This can result in reduced consumer spending, which can negatively affect the earnings of companies in various sectors, including retail and consumer goods, leading to lower stock prices. Economic slowdown. Rising interest rates can be a sign that the central bank is trying to curb inflation or slow down an overheating economy. In such cases, higher rates may be accompanied by tighter monetary policy, which can slow economic growth. Slower economic growth can translate into lower corporate earnings, which can, in turn, lead to lower stock prices. Psychological factors. Investor sentiment plays a significant role in the stock market. When interest rates rise, some investors may become concerned about the impact on corporate profits and the overall economy. These concerns can lead to selling pressure and a decline in stock prices. It's important to note that the relationship between interest rates and the stock market is not always straightforward. In some cases, stock markets may continue to perform well despite rising interest rates, especially if the rate hikes are gradual and accompanied by strong economic growth. Additionally, other factors, such as corporate earnings, geopolitical events, and investor sentiment, also influence stock prices. Investors should consider a wide range of factors when making investment decisions, and it's advisable to have a diversified portfolio to mitigate risks associated with interest rate changes and other economic variables. Thanks for watching. Please don't forget to click subscribe if you want more weekly updates on investment strategies.